Fifth time of recording this, guys. I don't know. We've been having some technical issues. Let's dive into the markets right now. Those are who are holding TLT and interest rates. That's all we're talking about. I'm going to talk about the charts and then I'm going to talk about the macro. Let's start with the macro because I find it boring, but it's pertinent because it plays out. ADP numbers came in November unexpectedly. They fell by 32,000. So look, guys, the bulk of the economy is based on small, medium-sized businesses. They're the ones first to feel the pinch when it comes to the interest rate increases. This is showing less job participation. There's less jobs created, and unfortunately, the smaller companies have to release people. Okay, it's not because of AI. It's because the economy is becoming weaker. There's also less demand. The economy is not built on narratives of AI, new technologies. It's built on human consumption, demand, and supply. So in this case, the demand is decreasing significantly. It has been decreasing significantly. Consumer sentiment is collapsing. Households are facing the consequences of the rapid increase of interest rates. All these are huge recessionary signs. It's a tanker that's taking a long time to turn, like Henrik likes to say, Henrik Zeberg. So it's going to take a very long time in order to see that played out. But that time has passed. We're going to see it very, very shortly. I believe in the next coming months we will be talking about us being in a recession. Although Trump being in the administration, we might not see that being really syndicated because it hurts the administration. It's not his fault. There's not much he can do. Let's look at the charts though, because that's what's more realistic. The charts are showcasing right now potential head and shoulders formation. Here's the shoulder, the head, and the shoulder. If we do not close above the neckline, it's not going to be confirmed. We need several days of confirmation above here, and we might see a jump back to the golden ratio. And this is not a Fibonacci. This is Pythagoras. Fibonacci copied Pythagoras. All these are, if you look at the Greek letters, are equivalent to infinite numbers. So in this situation, the golden ratio 0.618 is the next potential move if, and I repeat, if this pattern plays out. Because if you look at the top of the head to the neckline, that's where it takes us. But surprise, surprise, and this is why the graphs indicate everything. This trend line over here has showed for several months consistently that it is the resistance. It's not a coincidence that this resistance has been played out. So I wouldn't be surprised if we jump here to this level because it meets the resistance at some point. So we could come back to the 4.8 or maybe 4.9 max and then have the significant drawdown. Why? Because there's a lot of pressure coming in from the Japan the yen carry trade, which we know was a great way of getting cheaper capital into the West. So there was this recycling, especially investors like Stanley Druckenmiller, George Soros, etc. They've talked about this in lengthy detail. We're seeing what's happening in Europe. The war is increasing, and there are a lot of countries who are preparing. But again, I do believe that a lot of capital will come into the U.S. Now, if the money capital, if it doesn't go into bonds, which I suppose there are stipulations for that, if they go into the money, if they go into the markets or in other investments, yes, they will increase and appreciate the currency, which I don't think Trump really wants to do at this point. And I suspect that a lot of that will go into treasuries, into bonds. So we talked about the macro, we're talking about the charts, but I want to talk about M2 supply again because a lot of people have been wondering, so what's going on with the money supply? So the M2 supply is the balance sheet, right, of what the Fed owns. And what the Fed mostly owns is treasuries. They buy treasuries. So even though Japan might be selling treasuries, let's say, or China, which we know is doing, or Russia, or other countries of the BRICS, it doesn't matter because the US has the ability to buy back its own treasuries. For how long? We don't know, but it will keep happening for the next few months, the next few years, for sure. And we're seeing that this chart here is showing a parabolic move. This is not going to stop. There's a strong momentum, and we haven't even reached the overbought situation. We're getting there, but we still have several months of an increase in the M2. I see this right now as a, and you can tell here that we bottomed based on the MACD. It's showcasing right now this divergence, this bullish divergence. So we're going much higher. The bulk of the M2 supply goes into treasuries, because somebody asked me. You can look that up. So what happens is that in order to create more capital flow, you need to essentially buy back treasuries to create as a collateral to create liquidity. And that's what the Fed has been doing. Okay, guys, it's not just printing money out of thin air. They have to buy back treasuries, which you could say is the same thing. Now we're seeing the long-term treasuries meeting the resistance. This resistance has been significant for the last 2.5 months. So I do think that this will not play out. I mean, this is the worst scenario, that we come up here and then come down. So, but I think there are a lot of pressures, significant pressures that are that want rates coming down. And once rates come down, the American household will feel en masse that it has to refinance the mortgage. And once they refinance the mortgage, interest rates will keep coming down. Okay, so I think that people who are holding TLT should be very, very patient and add. That's why I say don't add all your money into it. Be patient and add as we go. This is a major rounding bottom. Just think, treasuries halved in a period of 2-3 years. So they negated all the gains from the last 30 years. That's ridiculous to think about. Nowhere in no market would you see that. I mean, that's something that you see in a meme stock or in Bitcoin, right? So that leaves us, in terms of the reward to risk ratio, a lot of room for potential reward versus the risk. I would say that bonds could drop maybe 10%, worst case scenario, at this point of time. The stock market, though, is not going to reverse just 10%. If it's going to be in a bear market, or if it's going to be in a situation where the economy is really, really, really bad, okay, the market is going to have to correct way more than 10%. So I think that TLT is the best place to be right now if you don't want to be in the markets, although I do see a push higher. So we talked about the macro, we talked about the charts, we talked about the M2 supply, we talked about interest rates. So I do think that TLT right now is the place you want to be. We might see a few hiccups here, but overall we're going much higher. Nothing goes in a straight line. It takes time to consolidate. And remember, there's also counter trends. And the markets are not easy because they always test you. So that's why, like Stanley Druckenmiller says, who's one of my favorites, you need, in order to have asymmetric trades like I talked about in TLT, you have to have conviction, and you can diversify. Diversification is for the people that are agnostic. If you're agnostic and you don't have any nay or yay about anything, and you just want to sit on the sidelines and be passive, sure, diversify. If you want asymmetric trades to gain time in your life, okay, which you cannot get back, you can only gain some of that through increase of money, these trades are good for you. The TLT right now, I think, is a really good option. Long term, give yourself room for the options, and we'll see what happens in the next coming weeks. But I do believe in 4 weeks from now, we should be much, much higher. Okay, thanks so much, guys. Bye for now.